I just did a video on Berkshire, and I'll show you the results. It's kind of always overvalued because people just are willing to pay a premium for his knowledge, for that safety. But like I said on yesterday's video, there's sometimes I pay for a stock I think is overvalued. Like if according to my model it's overvalued, I may buy the stock. And if I do a model on, say, another stock that's undervalued, I don't buy that stock. The model is just one piece of the equation. And I don't even think it's the biggest piece. I'd say maybe 10% of my decision is discounted cash flow model. Because if you just could run a model and find out whether the stock is over or undervalued, we'd all be rich. It's not that easy. Things can stay undervalued for years, and stocks can be overvalued for years. So it's not about just buying it. It's about waiting for the big jump, or maybe waiting for the pullback before you get into the stock. I'll show the DCF. We'll go through the letter. So according to the DCF, I did in the B shares. So I'm at $3.43 per share. They're trading at $4.78. And it's an okay stock. It's not the greatest stock to do a DCF on, but it definitely works for this stock. Other stocks, like a regular retailer, DCF works well. And then there's some companies where DCF just doesn't work at all. I think it's a decent stock for the DCF, but it's usually overvalued, like it is in this case. But people are willing to pay a premium for things. It's kind of like a Ferrari. Ferrari is a really expensive car, but people are willing to pay that premium for whatever reason. Maybe they like the car, maybe the status. It could be a number of things. And there's cars that are probably undervalued, that are cheap relative to the competition, and people aren't going to buy those cars. Maybe it's a brand name thing. So we'll just go through the letter. Maybe we'll get more insight. The good thing about Buffett is he's a straight shooter. So he's not going to paint a rosy picture no matter what the situation. Because if you ever read a normal quarterly or annual report, everything is positive. Even if the company's on the verge of bankruptcy, it's still positive. They always paint a picture. Everything's going to be all right. And even if they have a bad quarter, they're setting themselves up for the future. So let's see. That's the beginning. Okay. Right on the first page, mistakes. Yes, we make them at Berkshire. Sometimes I make mistakes in assessing the future economics of a business. This happens with both judgments about marketable securities. We view these as partial ownership of businesses and 100% acquisitions. They own 100% of Geico, but other companies, they just own part of those companies. Apple, they own part of Apple. And so do you, probably. At other times, I've made mistakes when assessing the abilities of the managers Berkshire is hiring. A decent batting average. The cardinal sin is delaying the correction of mistakes, or what Charlie Munger called thumb sucking. Problems, he would tell me, cannot be wished away. They require action, however uncomfortable that may be. So if you make a mistake, we all do, instead of sitting on that stock for another year or two, tying up your capital, maybe you have to cut your losses. You don't really know the future, but if you do proper due diligence and you pick good stocks, sometimes I've taken losses. Here's a good example, and I said this to the guy on the live stream yesterday. Say it doesn't really matter what stock. We'll just do Apple. So say come on. Oh, I hate this keyboard. It's old. It gets stuck, the keys, and it's hard for it to work. Okay. Let's just pick Apple. And it doesn't really matter what stock it is. So if you own 25,000 of Apple, some people say, is this a good time to sell it? I think, you know, and it really doesn't matter how much you made on the stock. Say, okay. So say you bought 15,000 of Apple, and now it's worth $25,000. So you're up 67%. So buy or sell. So some people will think, oh, a buy. That if they profit on a stock, they're okay selling it. On the other hand, like let's say you purchase both stocks at the same time, like maybe 2 years ago. You bought 25,000 of Amazon. These aren't real numbers. And now you're down 33%. So some people think, Kira, what does ticker mean? Ticker is just the symbol of the company. Like T is a ticker for AT&T. Are you in the US, Kira? Oh, Kira, I know Kira. Sorry, that's my cousin. Okay, yeah, Kira's new to investing. Ticker is just a symbol. What are we talking about? Walmart yesterday? I think it's what's a symbol? Is it WMT for Walmart? Yeah, WMT. It's just if you want to buy Walmart shares, you could type in WMT. It's just I guess a quick way to. Okay, so say in January 2022 you bought this much of these stocks, and that's where you're at so far. So some people have this idea, I can't sell it at a loss. I just want to at least just want to break even. And I'm not saying it's a bad philosophy, but it's not what I would use. So it doesn't really matter when you bought a stock. It doesn't matter whether you're up or down. You should look at it in the basis of, if I owned so you have $25,000 worth of Apple, right? Just pretend you don't have any Apple, and say to yourself, I'm going to give you $25,000 of cash, and you have to buy one stock. So the question is, would you buy Apple? if I gave you 25,000 of cash and you could only buy one stock, would you buy Apple? And if the answer is yes, then I would say, then hold your Apple. Don't sell it. And if the answer is no, you don't like it, it's overvalued, I'd rather buy I'm a CVS or whatever stock, then I would sell it, maybe the Apple stock, and maybe buy CVS. So that's kind of like a real simplified way. I'd buy McDonald's. It's so good. Exactly. Buying stock that you like the company. I know that's a simplified way, and it's easy to say when you have no money on the line. But that's how you should look at it. If whether you're up or down on a stock, if you hate the stock, like you think the stock is in bad shape, then just sell it. Don't hold on to it, because you don't know the future. Obviously, you don't know the future, but you just have to go with how you feel, right? And you could be borderline on stock, so then I go either way. Whether you're up or down, sell if it looks like the stock has started. And don't try to time it. People tell me this. People who are kind of intelligent, I always hear like, oh, I sold my Meta stock because I think there's going to be a downturn, so I'll buy back in. That rarely ever works, because it was like NVIDIA. Remember when NVIDIA was, like, I forget what it was, like 200 billion market cap, and then oh no, NVIDIA was like, I think it was up to like 400 billion at one point, and people were like, "Oh, I missed it. If it ever gets back down to a good number, I'll buy it." And it came down. This is like recently. I'm talking about like in 2021, 2022, and it came down from like 400 billion to 200 billion. Most people didn't buy it, even though they said it, and it went from 200 billion to like almost 4 trillion. So people generally don't do what they say. I'll just buy back when it comes down, or I'll sell. Usually you end up missing out on a lot of gains. So just buy and hold. There's no way you'll time the market. 2 years ago is a long time, but in terms of I'm just talking in terms of NVIDIA. I'm not talking about like back in the year 2000, you could have got NVIDIA for like, at a 20 billion market cap. But who knew 20 years ago? And it's hard to sit on stock for 20 years. But it was pretty recent. It was 200 billion market cap 2-3 years ago. So and you could have still 20x your money in just like 3 years. Because it's so easy to say, oh, I should have bought Amazon 25 years ago. I'd have $1 billion. It's hard to do, because I'm sure there's a lot of stocks you might have picked 25 years ago, and it's really hard to sit on a stock that long. See, even back in like, 20. I think this point I'm talking about, it was 22 and at the end of 2021. And then it peaked at 32, which I think was 200 billion market cap. And then people, oh my God, NVIDIA, I can't believe it got that high. And then the big pullback, it went from 33 in November 2021. I think it hit 10 here. So it came down in half. And this is at the end of 2022. I'm not talking about like in 1998. I'm talking about at the end of 2022, you could have got it for nearly $10. So it 15x'd just in 2.5 years. Are you reading line by line? No, I don't think I'm going to read line by line. It's too much. So from 2019 to 2023, I've used the words mistake or error 16 times in my letters to you. And you never hear those words from other companies. They'll never say that stuff because they don't want to scare investors. They don't have faith in themselves where they can be honest with you. They're too scared. He does mention Amazon made some brutally candid observations in their 2021 letter, which is not common for a big company or a public company. And they're not going to say, I mean, I think even Elon said it once. What did he say? Something about like EVs are overpriced, or I don't know anybody who would want to buy an EV, something like that. Remember? And then his stock went up like 30%. Just he's bashing the industry his company's in and the stock. But Elon's a different animal. He can do whatever, and people will buy his stock, whether he's bullish or bearish. So he's 94, and Greg Abel is going to take over as CEO. I know a lot of people are saying, and it's kind of the easy out. When I tell people, oh, I own Berkshire, that they say, oh yeah, I don't. It's going to go down a lot when Warren Buffett dies. I would sell it. But I mean, it could. But I mean, if you really think about it, they buy companies, right? I don't know why they would. And Greg Abel is working side by side. I mean, he's making most of the decisions at this point. So I don't know why he would just do an awful job. Sure, the stock may go down when Warren dies. Maybe. I'm not saying will. Maybe just out of like people are scared, or they like the fear of like there's a big sell-off, and so there are people selling off and taking their gains. But it's going to rebound. If it does, it's a good buying opportunity. What's bullish or bearish? Bullish means I think a stock will go up. Bearish means I think it's going to go down. He talks about this guy, Pete Legal. He died recently at the age of 80. I didn't read the whole thing. I think maybe Warren bought his company. But I guess we could skip that one. I don't really. Okay, last year's performance. In 2024, Berkshire did better than I expected, although 53% of our 189 operating businesses reported a decline. And if you think about that, more than half reported a decline. If you're a private equity guy, if your batting average is 100, you might be doing really well. You don't need, like, say you invest in 10 companies. Let me know if you don't know what private equity means. So you have a private equity firm. Private equity just means a company that invests in private businesses, not publicly traded companies. So you can make money by investing in regular companies that don't trade publicly. For a number of ways. Maybe you buy the company and they become public. Then you probably would make a ton of money. Or you just buy the company and they remain private and they are profitable. So you make money that way. So when you invest, if you put like $10 million in each of these 10 companies, usually private equity is not your own money. You have a pool of investors. Because not many people have $100 million just to throw at 10 private companies. Although some do, but you may own just 2% of this company, this private equity firm. So 2% of the 100 million is yours. You put 2 million up. So 5 of the companies, you get no return at all. Well, not no return. You get a negative 100% return. Okay. So that's pretty easy. What's your value? Say you invest in 10 companies, and let's look at the value after 5 years or after 10 years of owning those 10 companies. Chances are half of them go bust. They just go out of business. And then maybe 2 of them, you're at the break-even point. You didn't even, it never moved. They're still trying to expand. They're still trying to grow. This is so freaking annoying. One of them, you have a 50% return. One of them, you have a 250% return. This is assuming you did your due diligence. And one of them, you 25x because they went public, and you were able to. So you took that 100 million and you more than tripled it. So this is kind of like, if things go right, of course, you could be bad at your job and they all tend to go bust and nobody invests in your firm and your private equity firm goes bankrupt, which happens a lot. But this is kind of like if everything goes as planned, you expect something like this. 7 of the 10, you pretty much get no gain for, and then you may have 1 or 2 real big winners. And if it's a really big winner, you can have like a 32,000%, which isn't even that far off, especially if the company grows to 100 billion market cap. I think was it Masayoshi Son, SoftBank? He put like, I can't remember what it was, into Alibaba. How much did he invest? I don't even think it was $1 billion. I think it was, let's see. Yeah, he invested 20 million into Alibaba in the year 2000, and that turned into 60 billion. I mean, so if you get something even a fraction of that, you're doing a good job. Because I can't mentally do this, Scott. I was in a special ed math class. Okay, you don't have to pay attention, I guess. So let's go back to the Berkshire. So even if half of his because he has 189 operating businesses, because he invests in companies. He doesn't actually make anything. He doesn't provide any services. He doesn't make any products. He just buys companies. So he has 189 companies. Bank of America, Apple, and there's Geico is a big one, but there's a lot of private companies. So half of his companies lost money. or there was a decline in earnings, so went down. But that doesn't matter, because even if you get, like I showed you this example, even if half have 100% loss, you still can be profitable. You just need 1 or 2 home runs. And his home run was Apple. He owned almost 10% of Apple at one point, so he made probably a couple $100 billion just on Apple in profit. So, okay, our insurance business also delivered a major increase in earnings, led by Geico. He does P&C, property and casualty insurance, railroads, utilities, kind of like staples, things we need to live. Like, you don't realize how needed railroads are. Just because you don't take them anymore for transportation doesn't mean they're really needed in all countries. In America, in Europe more than actually in America, but it's in order to transport products like food and grain, or that's a great way to do it. Because it's hard to you can't really transport by plane, because you can't fit that much on a plane, right? And you could do by truck, but still you could only fit maybe 1/20th of a truckload, like on one on a bunch of rail cars could be like 30-40 trucks of product, and it's a lot faster, and you don't pay as much for fuel because there's no you don't have to stop. Like when a truck is expensive because you need somebody to drive it, and there's fuel. Trains are much more efficient. Okay, so they had operating earnings of $47 billion for 2024, which is up like $10 billion from 2023. And he strips out gains and losses on stocks and bonds. He always talks about that. Here's a breakdown of his EBITDA. Of the $47 billion, you see insurance is like nearly half of it, $23 billion. And then his energy arm. And this is like in the other controlled business and non-controlled businesses. This is where you'll find like Apple, Kraft Heinz, or the publicly traded stocks that he owns. 60 years he's been doing this. So he's been running Berkshire since 1964. It's a long time. Where is your money? It's in 189 subsidiaries. Some of it is common stock. Some of it is just private companies. Apple, American Express, Coca-Cola, Moody's. So he had 270 billion, I think, of tangible equity. Okay. Despite what some commentators currently view as extraordinary cash. Oh, here's the cash. This is interesting. Our ownership in marketable securities moved downward last year from 350 billion to 270 billion. Marketable securities are like what's it called? Like CDs or bonds, things like that. Money market accounts. Okay. Berkshire can rest assured that we will forever deploy a majority of their money in equities, mostly American equities, although many of these will have international operations. Berkshire will never prefer ownership of cash equivalent assets over the ownership of good businesses. Paper money can see its value evaporate if fiscal folly prevails. In some countries, this reckless practice has become habitual in our country's short history. So he talks about cash a little bit. Where's that exhibit A? True in our country, blah, blah. Insurance is a big part of his business, but it is a little kind of confusing trying to understand how insurance companies work. I kind of understand on a high level, but he understands it obviously really well, but I get a little confused when they kind of dig deep into Lanko Bear. Thank you. I appreciate it. The good thing about Berkshire is, well, with insurance companies, they have what you call float. And this is how a lot of companies, insurance companies, banks make money on the float. So to put it simply, like credit card companies, PayPal, for instance, float is how they make money. So like American Express. So when you use your Amex card, say you buy $75 of product. What's it? Let's just say you go to Bed Bath & Beyond and you buy $75 at the store. Well, let's use PayPal. I think it'll be easy to explain with PayPal. Say you buy something online with PayPal. So you give PayPal $75, and then PayPal pays Bed Bath & Beyond the $75. And then PayPal will charge a fee to usually the seller, and that's how they make money. But a lot of times when you deal with a company like PayPal or banks, they don't give the money right away. Like, so $75, they may actually give it to the company the following day, or sometimes 2 days or 3 days. So even though you only spent $75 on this purchase, when there's millions and millions of people, the amount of money at a given time, say at any given moment, PayPal is sitting on $100 million, and it's not their money. They just have to transfer it pretty much from one party to another. But they get to sit on it for a day, for example. So even though it's 1 day, they earn interest on all the money in their account. So I'll give you an example. Say rates are 3%. That's an annual rate. So this is the daily rate, 3% over 365. So that's how much interest they earn in 1 day, 0.008%. Did I do that right? Yeah. So when insurance companies and banks, like they have billions, sometimes tens of billions, hundreds of billions of dollars at a given time, that's generally the bulk of the way they make all their money is on the float, just sitting on funds for an extra day or two before they transfer it. And insurance companies have a ton of float because, like, if you buy a life insurance policy, they you pay upfront or you pay annually. So if they have like, you know, 1 million people that pay $1,000 each for their insurance policy, that's $1 billion. But insurance companies don't have to sit on the funds for a day. Chances are they'll sit on these funds for a few decades. Because if you buy a life insurance policy, so just in case you die, your family's protected. Oftentimes, like 90% of the people don't even use the insurance policy. They don't, you know, if you die of natural causes at 70, you can't claim insurance. It's something like if you get into a car accident and die at like 45 years old, then your family gets a couple $1 million. So insurance companies sit on a lot of money because people are paying their premiums, sometimes for 10, 20, 30 years. So even though they have to pay on insurance policies, it might not be to many, many years after they're given the money. So that's why he's so profitable compared to a regular company, because he has so much money in insurance policies. Because it's like car insurance too. If you pay $1,000 a month or $2,000 a month for car insurance, depending on where you live, you know, that's a lot of people paying, you know, a few hundred or a few $1,000s a month, and the money just sits there. So insurance companies have an enormous amount of cash, and that's actually how the Great Recession got started, because insurance companies invested in subprime bonds. That changed a little bit. So if an insurance company has like $100 billion of cash just sitting there, they're allowed to invest that money, but as long as it's in high quality investments. You don't have to invest in treasury bills because that gives you almost no interest. You can invest in AAA securities that give you a 4 or 5% return. So that's what float is. In recent decades, this money up front, loss payments later, because that's insurance. You receive a lot of money up front and you pay losses later. And the idea is when an insurance company underwrites a policy, they don't want to pay anything in losses. They don't want to have to pay anything. It's kind of like your medical insurance or your car insurance. It seems like such a waste, especially medical. I'm paying like $1,500 a month, even though I still have it through my job, and I don't pay $1,500. I still pay like $700, $800 for me and my wife. It's a lot of money, and I feel like it's just wasted money most of the time because I hardly ever use it. But that's a different story. Depends on your CR, the superior, your loss ratios. It depends on the business too. If you offer car insurance, you will pay claims because people get into car accidents all the time. But certain type of insurance, it claims are really, because I used to do I don't know if I used to underwrite subprime mortgage bonds. I did at JP Morgan for 5 years. Then I worked on the insurance side. So we were insuring these bonds. So I did structured finance. So I did like aircraft receivables. I did mortgage receivables. But there was another group at my company that did muni bonds. So if what's it called? If a town, like a city, wanted to build a hospital for $400 million, they would sell bonds. And anybody could buy the bonds. It could be people in that town. So a $400 million in bonds, because say that's how much it costs to build a hospital. And the town may have a rating of BBB. So they would have to pay 6% interest on the $400 million. So every year they would pay. So the principal, the interest, interest rate, and the annual interest payments. So they'd have to pay $24 million in annual interest payments to the bondholders. So my company, we were assured guarantee. We're rated AAA, so we would wrap our rating. That's what we call it. So we would put our name on the bonds, and that way, instead of the bonds being rated BBB, now they're AAA, because we're insuring the bonds. And now the interest rate goes down to 4%. So the hospital that issued the bonds, they're saving $8 million a year in interest payments, right? And they would pay us $3 or $4 million in premiums. So they would save $4 million. So instead of paying $24 million, they pay $20 million. They pay $16 million to the bondholders in interest payments, and they pay us $4 million as our fee. Because there's risk. We may have to pay if the hospital defaults. So that's kind of what we did. And that's a really simplified way to do it. Obviously, when we did CDOs or CDO squared, it could get a little more complicated. So the way it worked is the hospital gets $400 million up front from the bondholders. And then once, maybe it takes 6-7 years to construct the hospital, they're using that $400 million. And then the hospital would operate, and then it would start generating income. And then they can use that income to pay the bondholder back. Or like even more clear is like a bridge. Like if you needed a bridge connecting your town to the next town, and you have a $500 million bond, it's the same idea as this, and they would use the tolls, how much money they receive in tolls, to pay back the bondholders. They'll pay the interest payments. So I think that's a little more clear on how it works than on subprime. On subprime, it could get a little hairy and complicated. Insurance is a scam. It is. I hate it. And I worked in insurance for 13 years. Well, I worked in a bank, JP Morgan, 5 years. Insurance, 20. When was it? Yeah, 2004 to 2000. Yeah, I left JP Morgan in 2004. In 2011, so 7 years in insurance. And 2012 is when I left New York. So I worked at JP Morgan 1999, 2004. I was there when Jamie Dimon, I think Jamie Dimon came in 2003. So I was there when he became CEO. It was kind of a big deal. I was supposed to meet him actually, because I won this award. Every year, they would do this superstar award, and like 50 people in the company got it. And you get 5,000 cash, which was cool. And they fly you out to New York City. And then they put you up in a hotel and you go to like a Broadway show. It's a big thing. I lived in New York City, so it wasn't that big of a deal. I could just, take the subway to the hotel. But people were flown in from other countries to New York City, and we all got together. And Jamie Dimon was supposed to be there to give us the award, but he didn't. He actually got rid of that award. He got rid of a lot of things at the company. He wanted to cut a lot of costs. But I'm pretty sure it was 2003 because I left in 2004, and it may have been 2002. Let's see. No, what am I talking about? I left JP Morgan in 2004. No, 2007. What did I say? Yeah, I left in 2007. That's when I went to Radian. Yeah, I got my years wrong. So 2006, that makes more sense. It was for just, working hard and like, I could these Excel in manual entry. It was arbitrary based on what group you're in. If you got because you get these write-ups at JP Morgan, people can give you a write-up if they think you're doing a good job, and then you're like a star. You get a star or something. And if the write-ups are significant enough, then you get like a bonus or yeah. Yeah, so 2006. So yeah, I remember a year before I left JP Morgan is when he came. 2006. Yeah, 2006. Okay. Ajit Jain, he runs their insurance arm. So he does a really good job. That's obviously the biggest part of the business. Think back 135 years when the world had no cars, trucks, or airplanes. Now there's 300 million vehicles in the US alone. Property damage arising from hurricanes, tornadoes, and wildfires is massive. All things considered, we like property casualty business insurance. So he talks about his Japanese investments. So it's almost 6 years since he bought shares in 5 Japanese companies. I'm not too familiar with the first 2, but I'm definitely familiar with Mitsubishi, Mitsui, and Sumitomo. Those 2 are banks. Mitsubishi, I'm sure you guys know what Mitsubishi is. I don't know. Let's see Mitsubishi. Let's see their stock. I don't know how they're performing. So 6 years ago, so 2019, he invested in this stock. So it's right here, 1,000 yen. That's 2018. Actually, 2019, it got down to 900 yen. So it looks like a good investment. It went up 300%, but it has come down from that peak, but still up a lot, like at least 200% from 2019. So he's doing well there. Berkshire made its first purchases in 2019. Right, yeah, he used Japanese Japanese yen debt. Exactly. But that's why he has access to a lot of cash through his insurance companies. So it's kind of like free cash in a sense, because he needs to do something with that cash. So he has a boatload of, of things to invest in. So who's going May 3rd? I want to go. And every year I say the same thing. So let me know if you want to go and meet up at the Berkshire annual meeting. I would like to go, but I keep kind of, for some reason, not going. It's a big event. It's a big deal. It's the most sought after annual meeting. Most annual meetings are not even that big of a deal. It's just like a 2-hour phone call, and nobody goes to it, except like maybe analyst goes to it to ask questions. Carrie refused any payment for work. Okay. So yeah, so he'll be just like the last few years. Greg and Ajit will be at the table with him. It was always fun with Charlie and Warren next to each other. But now, obviously, last year Charlie wasn't there. I think last year was the first year Charlie was not, right? Because he died before last year's meeting. Yeah, it's a big week of sales for Omaha. Like a lot of businesses in Omaha make really good money that week because there's so many visitors. And people visiting have money, so they're willing to spend. His sister is 91 years old, Birdie. He talks about her a lot. So here's his returns year by year compared to the S&P 500. So right off the bat, he made 50% his first year, which is crazy. He probably only had like $1 million or something, or maybe a few million. And his second year was actually a good year because he lost 3%. The market lost 12%. But this just show you 1967 was a bad year, and he made 13%. And 1966 was a good year, and he lost 3%, because you can't just look at the number. You have to compare it to a benchmark like the S&P 500, and that's how you'll know if you did well or not. 68, 78%, and the market only 11%. 69, he had a really good start because he had less money, so it was easy to get a better return. Because he says now it's hard because if I have to park $100 billion, some companies aren't even worth $100 billion, so I can't buy more than 100% of any company. Where back then he could buy pretty much, he only had a few million, so he could invest in a small piece of a really, really good investment. If he finds a really good investment now, he, likely it's not that huge of a market cap. So what's he going to buy? Like half the company, maybe? So 69. So 4, 5. So his first 5 years, he killed the market. He did better by quite a bit in the first 5 years. 1970, like I can imagine the people investing in 1970, because they probably heard, oh, this guy Warren Buffett, Berkshire Hathaway, really knows what he's doing. So people invested in 1970 and lost 5%. The market's up 4%. So they probably sold. And like, he doesn't know what he's doing. I'm not going to keep In 71, 80%. 72, the market, he didn't do as well as the market. That's his second year not beating the market. 73, he did well. Look at 74. Imagine in 74 investing and losing half your investment. If you put $1 million in 1974, and then at the end of 74, you have $500,000, you'd hate him. But if you kept your $500,000 in, you could have converted it to like $1 billion. But hindsight's 2020. Charlie wasn't there in 2020. Well, I'm way off then. He's been dead a lot longer than I. 76, 129% return. He beat the market in 77, 78, 100% return. 79, he beat the market. He pretty much tied the market really close in 1980. He 81, he was up 32%. The market was down 5%. 84, he was down, market was up. So that wasn't a good year. Look at 1990, he was down 23%. The market was down 3%. That was a pretty bad year. But the next 4 years, he beat the market. This is 95 was a good year. 96, not a good year for him. Because even if you make 6%, some people would say, well, at least I made money. But you can't look at it that way. You should compare it, because the S&P 500 is kind of like, you could just put your money in there. Why invest it in other things and take that risk? I think most people should just put in the S&P 500. I have a lot in it. Look at, this is the dot-com crash. So he avoided dot-coms. And by avoiding, he lost 20% in 1999. This is before the crash. And the market was up 21%. And people are saying, oh, he's an old man. He lost his touch. He could be investing in these amazing dot-com companies and earning a great return, but he's avoiding them. Avoided them in 2000. So when I look at 2001, I don't look at him making 6%. I look at it as like a 19%, like in the positive, because instead of losing 12, he gained 6. That's like that's a big return for 1 year, 19%. Even the next year, 2002, he lost 4%. That's like an 18% savings by losing 4 instead of 22. 2008 was a rough year. He did better than the market, but he still lost a lot. Victor, what's up? Good to see you. 2009, not so great. He only had 3% return. Look at 2015. He lost 12%. The market was up 1%. 2017 is when I invested. And in 2017, I sold all my stock, and I kind of did some research, and I picked certain stocks. I still have those same stocks from 2017, all of them. So I picked Berkshire, S&P 500, I think XLY, it's like a mid-cap ETF. I can't remember what else. There's one more. I think it's one more. So I only invested in 4 stocks. I still have all 4. So it was easy for me to track the S&P 500 compared to Berkshire, because I both bought them on the same day. In 2018, I was happy because I'm up like 40% or something like that, maybe 30% on my Berkshire, and my S&P was not doing as good because you see the market went down 4% in 2018. But then the following year in 2019, he only had 11% return, the market 31%. So my S&P is beating my Berkshire. And then the next year, 2020, he only made 2%, the market 18%. So now my S&P is beating my Berkshire by quite a bit. And I was like, oh, why did I put it into Berkshire? I could have just put it into S&P 500 and did better. But then things turned around. 2022, market went down 18%. He went up 4%. So now my Berkshire is clearly beating my S&P 500. I mean, both were up a good amount. But he only beats the market by 10% on average. So he averages 20%, market averages 10%. But when you compound it, the market's up 39,000%. So in 1964, if you put like $10,000, if you had 60 years to wait, you put $10,000 into the S&P 500, $39,054. If you put $10,000, which was a lot of money at the time in 1960, it's $3.9 million today. So you'd be pretty happy. A 10% compounded return. But if you put it into Berkshire, you'd have $550 million. Compounding, it's crazy, right? I read the earnings. It's encouraging that Buffett did not beat the market every year, yet it's like what I was showing you with the private equity. You don't have to, if you pick 10 stocks and if 5 go bankrupt, that doesn't mean you're going to lose money. If you just get one winner, it's like Berkshire. You don't have to beat the market every year. If you beat the market, actually, I want to see. Come on. Let me just do it. So there's 60 years. I'll just go down the line. It'll be faster. How many years did he beat the market? Well, how many years did he miss? That's easier to. So I'm gonna go through it. How many did he miss? So 0 misses 0. Okay, 1967 he missed. If he did not beat the market, I'll add 1. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. That's pretty easy. So he missed exactly 1/3. He beat the market 67% of the years he invested. So 40 out of the 60 years he beat the market. And he's still crushing it because of compounding. As long as he didn't have if you have a negative 100%, that wipes out your portfolio. So as long as you don't have a negative 100%, you're fine. It's kind of like that. I tell people, like I ask people, what's your favorite baseball team? This is common in New York. I would say this. Like, say I'm a Yankee fan. I go, what's your favorite baseball team? They say the Mets. And then I would say, okay, I'll make you a bet. Every game, there's 162 games. So every game, I'm going to add the runs. So the Yankees, and then you multiply your runs. I guess you got to be dumb to fall for this, but people did fall for it. So I said, okay, so I'm going to just add all the runs Yankees get from the first game to game 162. So I'm going to sum it all up. And for the Mets, you take the Mets, you can multiply. So I would say, you see, if the first game of the season, Yankees get 4, second game, Yankees get 5. So now I have 9 points. But if Mets get 3 runs the first game, 4 runs the second game, you get 12 because you multiply. So you can multiply the runs throughout the season. So if you're not too bright, you would say, yes, I'll take the Mets. If I can multiply, it's going to be like billions. But once there's a zero, it's going to be zero because they're going to get shut out. No team has ever made the whole season without getting shut out. So you see, the first 10 games, Yankees have 44 points because I'm just summing. And the Mets are going to always have 0. Because once there's a 0, it's 0 forever. Kira, you like that? I guess we were in elementary school because if you're in high school or higher, you probably can figure out you can't take the product of every game because it's going to be 0 at one point. You're busy but listening? And when you look at compounding, the negatives outweigh the positives. I think I did one of my first videos. I was talking about what was I talking about? It was on UCO and USO. Was it double levered short ETFs? It sounds weird. I know that there's a better name for that. Because when you double, like when you get an ETF, if it tracks the price of oil, so say oil is $100, and then each like week, the percent change of oil will have an equal change in your stock. So if oil goes up 1% in a week, the ETF will go up 1%. And if oil goes down 1% in a week, the ETF will go down 1%. But when you do the double levered, it kills you. Or the triple levered ETFs, because the negatives outweigh the positives. And it really drags down. That's why I like UCO and USO. Let me see if I can. So this is where your, let's see if I can figure it out. Your returns. Let's say this is your weekly returns. Let's say it's your monthly returns. It seems too big for weeklies. So if you invested $100, am I doing this right? I can't think how to do it. It was one of my first videos. I talked about UCO and USO. I can't forget how I did. Oh, it doesn't matter. Okay, so yeah, it was an interesting letter. They didn't really get into his holdings, which would have been nice. I guess you can find it. Berkshire Holdings. I always like to see what stocks he owns, what he bought, what he sold. A message, annual, interim, links. Common stock information, is that? I guess that didn't change. This is the annual letter. The quarterly holdings, I guess that hasn't changed. Holdings as of 12/31. So if you wanted to see the holdings, you can just go to the SEC website. It's the 13F filing. So beyond, what happened? I can't really tell. Well, these are the holdings, but I want to see what he bought and sold. I guess that didn't change. That will change, I guess, when a quarter ends. He owns 22% of Amex, 9% of B of A, 44% of DaVita. Kraft Heinz, that's not done well for him. That's been struggling. Liberty, the insurance. Yeah, he likes rating agencies. Moody's. Doesn't he have S&P also? I mean, Sirius, 35%. So Apple, he's down at 2% of Apple. I think at one point he was about 10%. But still, 2% of Apple is $74 billion, which is a quarter of his portfolio. It used to be about half. Apple was half his portfolio. 300 million shares of Apple. That's crazy, right? These are publicly traded companies. For the Geicos and other companies, that wouldn't be on the 13F filing. 20. Oh, is the annual? This is the annual report. Okay. I guess this is the. I was looking for like the income statement, but it's not here. It's okay. Here it is. Okay. I was just gonna. So the reason he shows so he shows like a net loss in 2022. Yeah, so like in 2022, you could see his revenue. It was 300 billion in 2022. Now it's 370 billion. But he had a net loss of 23 billion in 2022 with 300 billion of revenue. And he had a net profit of 96 billion in 2023. So revenue didn't go up that much. It's just these investment gains and losses. I've talked about this before, and he tells you to ignore this number. Just focus on like strip out this number to calculate the net income. So he should have 40 billion of net income in 2022. And this $75 billion gain in 2023, you could ignore that. So it should be 19 billion. It's just mark to market. So if he has, it's probably more. Say he had 200 billion of Apple in 2022. In the beginning of 2022, 200 billion. And then at the end of 2022, he had 150 billion of Apple. So he would have to show a negative 50 billion in investment losses. This is just for Apple, but I'm just giving you an example. So in 2022, just for Apple, he would have had to show a $50 billion loss. And let's say 2023, so he starts off with 150 billion of Apple, because that's January 1st, 2023 is the same as 12/31/2022. And Apple went from his value of Apple, like his stock in Apple, went from 150 to 225 billion. Well, let's do 200 billion. So he would have to show a gain, investment gain, even though he didn't sell the stock. If he sold the stock, it would not show up here. This is only stock he did not sell, unrealized gains and losses. So you can see in January 2022, he had 200 billion of Apple. And then by the end of 2023, he still had 200 billion of Apple. So his value of Apple did not change at all. But in 2022, he reported a loss of 50 billion. In 2023, gain of 50 billion. That's why he says just ignore it, because the SEC requires him to market his equity investments. So there's these huge fluctuations, but when you kind of combine it all, it's not like the stocks. It's not like this. Yeah, it's just kind of, it's market movements. It's just like your portfolio. You don't have to market because you're not a holding company. You don't have investors. But if you did mark to market, you might see these huge movements. Like say you make $75,000 a year. You should do this. This is a good way to learn. So your revenue is $75,000. Your expenses are just your taxes. So $25,000. So your net income is $50,000. But if you mark to market your investments like he did, showing unrealized gains or losses, just because you made 75, you might have been saving for the past 25 years. So in your investment account, you might have like 300K, say on January 1st, 2022. And it's 250K on 12/31. So you had a loss of 50K. So this is called investment. So you have to report investment gains or losses. So actually your net income is at zero. You have zero net income for the year in 2022. So if you showed this to like your wife or your friend, they would say, that doesn't make sense. You didn't make zero. You made like $75,000 of taxes. No, you receive 50,000 of cash from your job, but your accounting net income is zero. This is like his accounting net income. Or if it was the opposite, and this is 2022. In 2023, say you went from 250K to 300K. So you had a gain of 50K, even though you didn't sell it. So even though you only made 100K, 50K from your job after taxes, your net income is 100K. And if your wife says that doesn't make sense, you didn't make $100,000, you say no, it's accounting. I got 50,000 according to the statement of cash flows, but my net income, my accounting income is $100,000. That's why accounting could get funky. You report like these massive losses, a $23 billion loss. You would think the company's going bankrupt. A $23 billion loss. They're doing terrible. But when you look at a statement of cash flows, that's how you'll know how the company did. Does that make sense? I think to me it makes sense, but but now only 4 people here, so I guess it's a little confusing. Okay, well, thanks for joining. I'll talk to you later.